The steady internationalization of China's renminbi will see at least 40% or $100 billion of China's trade with Africa being made using the currency unit by 2015. On the line now from Beijing, China, with more is Jeremy Stevens, economist at Standard Bank. Thank you so much, Jeremy, for joining us. Appreciate your time. We're talking about internationalization versus a new reserve currency. Tell us about the differences between the two, because I think that a lot of people have misconceptions about more transactions coming through in renminbi and saying that this is going to result in a new reserve currency, and that being the yuan.
Well, hi, yes, good afternoon. It's a pleasure to be with you. I've missed your show from Beijing, so it's nice to participate. Look, yeah, you're right. The program's been presented in quite sinister undertones by some who sort of see the world in zero-sum lenses. To be honest, China's not preparing to dump dollars. China doesn't want to see the renminbi necessarily usurp the dollar as the world's reserve currency. These fears are very much misinformed, and it's what we tackle in our paper. An international currency is simply just one that you can trade and invest and transact in. And given global fragility, it makes sense that China looks to remove its reliance on dollar funding, to make its economy less sensitive to the flow of the dollar's trajectory. But again, that's got nothing to do with being a reserve currency. That's about storing of value. That's about reserve banks wanting to hold your currency as an asset, and China's not necessarily that interested in that from our perspective.
Well, as you mentioned, as transactions start increasing when it comes to the African continent, and synergies are very evident between China and Africa. Tell us about the opportunities that actually arise for Africa, because now we're looking at currency trading in a sense. Essentially, when you wanted to embark on import-export, of course, the dollar was the way to go. Is this going to start bringing down the cost of doing business for Africa?
Well, absolutely. I mean, we think so. First of all, obviously, today, a Chinese firm wanting to export to Africa essentially know that they're going to receive dollars in the future, and they're worried about the value of the dollar going forward. So they convert that at a cost. At the same time, we build that into our pricing, and we have to buy dollars before we buy renminbi. And the whole process, essentially seems to have one extra leg of FX transactions, which we believe China is trying to remove in a quest to lower the cost of transactions. At the same time, you're likely to see more sources of renminbi liquidity flowing into the continent. Essentially, the Chinese government has told its companies to carry on going out, but to go out in renminbi, and this has given them a lot of potential funding, which is also likely to come at a cheaper cost, and that allows us to, attach those to infrastructure projects and other priority projects across the continent that build for our future growth. So there are a whole load of synergies that we see, that we discuss in the paper, and obviously Standard Bank, Africa's largest bank, we're trying to create products that facilitate these transactions.
Well, it's also quite fascinating when you look at reserve holdings of African central banks. Tell us about how that's going to change the scenario on the African continent. Do you think that most central banks are going to start having a very big holding in renminbi going forward?
Well, look, a byproduct of doing more and more trade in the renminbi is going to be that central banks are going to feel more comfortable holding the renminbi as part of their reserve portfolio. As I said, I don't see this in the light of this is about usurping the dollar, but we do think that currency swaps are in the pipeline between some of Africa's largest central banks and the PBOC. And we think, if we look at the kinds of products that China exports into Africa, the kind of markets that they're going to focus on are going to be regional ones with deepish financial markets, with growing prospects and already deep ties. So we think that obviously sees Nigeria, South Africa, but also Kenya and maybe later Ghana and Angola to look to undertake currency swaps to help them with balance of payments crisis, or to help them fund trade and investment flows. going forward.
Well, let's just look at the downside. We know that there's been a lot of talk and rhetoric and debate around the strengthening of the renminbi, and we know the Chinese government has never allowed the renminbi to actually be a free-floated currency. Surely this is going to result in more strengthening of the renminbi. How's that going to then impact trade with China? Surely if we see a strengthening of the renminbi, then that is going to mean that imports, of course, are going to change the scenario on the African continent with regards to cost, surely.
Yeah, very much so. There's a possibility of that. We do see the appreciation of the renminbi as inevitable. We also see it as part of the PBOC's intentions to curb and cool inflation going forward. So we've got a forecast of about 5.5 to the dollar. So we see it appreciating, but at the same time, that's about dollar weakness, and that dollar weakness is manifesting across a range of currencies around the world, and African currencies could also see themselves appreciate against the US dollar over the next year or two, especially if we see sort of some of global risk return, perhaps in 2012. And this is all going to be positive for African currencies, and as long as African currencies are appreciating at a similar rate, which is likely given the PBOC's preference to be gradual, then we don't see too much problem from that side. And again, given the cost saving that could result in less FX hedging or cheaper funding, we think that will significantly outweigh the possible damage that comes with losing purchasing power relative to the renminbi.
Well, Jeremy, I mean, you're on the ground, you're in Beijing at this point. We keep having this debate about a soft versus hard landing. You're seeing things firsthand there. Tell us about what it's like in China at this point, and whether you're convinced that China is the silver bullet in the global economy to save everyone from the dire debt overhang that we're seeing in the developed market.
Look, you're right. I mean, one of the bright sparks in the world economy has to be China. Any way you look at it, we do still see the Chinese economy continuing to expand over the next year or so. We've penciled in, economic growth declining slightly from about 9.5% last quarter, gradually to about 8.2% for the year end. But, 8.2% is hardly a hard landing. It's not even really a soft landing. And as long as the global economy can avoid outright disaster, for us, we're still comfortable that China's internal dynamics are really robust. And, every day I sit with traders around the world, and they're far more panicked than anyone I see in China. And that's obvious because, China is relatively insulated as it stands at this moment.
Fantastic, Jeremy. We have to leave it there. Thank you so much for joining us on Power Lunch. That was Jeremy Stevens, economist at Standard Bank.